For obvious reasons, runs on banks are bad. And once they start, you can't really stop them. Companies can't make payroll, innocent people lose their life savings, the American financial system melts down. And suddenly all the preppers who stock a year's worth of powdered goat's milk in a bunker look really smart. That's where this was headed, truly. So here's the good news. That won't happen. Now the bad news. Despite what Treasury Secretary Janet Yellen said yesterday, there will be more bailouts.
The reforms that have been put in place means that we're not going to do that again.
Yeah. That's the same thing we were told after the 2008 bailouts. Oh, never again because of all the new protections. Taxpayers bailing out mismanaged corporations goes back a long way in U.S. history. 1792, Hamilton bailed out the securities market. 1980, Fed saved Chrysler Corporation. 89, taxpayers paid $124 billion during the savings and loan crisis. That was 1989 dollars. Then there was the airline bailout in 2001 after the September 11th attacks, followed by the Great Recession in 2008, the bailouts of the banks and everybody else. Most recently, the 2020 COVID airline bailout as well, which brings us to the second and maybe even more important part of this story. The people who caused the problem will face zero consequences. We know this because it happens time and time again. They know this because it happens time and time again. From the airlines to the banks, the CEOs never face real consequences. They might lose their job or some of their stock options, but long term, nothing. In fact, they can go start a new bank tomorrow. Just for an example, let's look at Silicon Valley Bank CEO Gregory Becker. Any fair-minded person with half a brain can acknowledge, at best, at the very best reading of the situation, he screwed up horribly. He argued for fewer regulations and took advantage of them. He failed to diversify the bank's customer base. He failed miserably at managing the risk of rising interest rates. The list goes on and on and on. And yes, he got fired over the weekend. Yet last month, he cashed out $3.6 million of stock. He gets to keep that. That's on top of the roughly $10 million a year in compensation he made as CEO. He gets to keep all of that. Being a bad businessman isn't against the law. But all the airline CEOs who failed to create a rainy day fund, they got to keep their jobs through the bailouts. All 3 bailouts in 20 years. All the bank executives and Wall Street guys who made tens or hundreds of millions of dollars on mortgage-backed securities got to keep their money and keep working in the financial industry after 2008. I could go on. The problem isn't today. President Biden and his team took decisive action, and there will not be a nationwide financial collapse.
Americans can have confidence that the banking system is safe. Your deposits will be there when you need them.
But, and this now is a big but, this bailout, just like the last ones, sends a message to every bank CEO and airline executive in the country. Take as much risk as you want, as clearly Silicon Valley Bank did. Be as greedy as you want. And when things blow up, because inevitably when you are greedy and take risks, they do blow up, you get to keep everything you made. You won't face a single consequence. No ban from the industry, no clawback of past salary and bonuses, no pariah status among your peers. This bailout had to happen, but the profound and continued unfairness to all of us does not. That's On Point tonight. Trish Regan is here, longtime business journalist, former Goldman Sachs trader. But we start with Blake Berman at the White House with why your money is indeed today safe. Hi, Blake.
Hi there, Leland. Pretty remarkable scene that we saw over here at the White House earlier this morning when you think about it. Before the day started, before the work week started, before the banks opened up this morning, before the bell rang on the corner of Wall and Broad, the President of the United States started out the week going before the cameras and tried to reassure that part of the economic backbone of this country would be just fine. The president today saying that those who had money at Silicon Valley Bank and Signature Bank as well would be made whole, even if it's above the $250,000 federal insurance limit. And he also made the case that the banks would be the ones funding that cost. He pointed to the fees and assessments that the banks pay into the FDIC, saying that is not taxpayer funds.
Thanks for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to subscribe. Click the red button to get more of NewsNation's fact-driven, unbiased coverage.